All right. Thanks for turning around your lunch so quickly. We're going to start with the penultimate session of Cryptoeconomic Systems 2020, which is Philosophy of Cryptoeconomic Systems. Now, it's unusual to see a philosophy session in a cryptocurrency conference. So the session chair, Shira Frank from Maiden Global, who's standing beside me, is going to give you a bit of a contextual framing. So I'll hand it over to Shira. Thank you.
Thank you, Wasim. Thank you. Well, may it never be unusual again to have a philosophy session at a cryptography or cryptoeconomics conference. So I'm going to invite you to feel something maybe a little unorthodox. I really hope that we feel incredibly dissatisfied after this session, actually. I hope that we feel hungry. I think this session could take up an entire 2 days, more than that, and we have under 2 hours. So as I was reading all these papers and reflecting on what we're asking of ourselves in the world to transition into new economic and psychological models for how to experience and exchange value, I felt like, yeah, it's okay to ask you to be a little uncomfortable and hungry. That means we've done our job. And if Wasim were up here right now, he'd also say that we're really just still minting our philosophy right now. We're doing the initial inquiry. We're creating these taxonomies. It's so early in this field that he called it, we have a very grainy, low-dimensional map. So I hope that as you listen to these speakers and you think about the questions that are plaguing you, or that you might want to consider if you're designing systems that affect how people operate financially, that you recognize we're at the beginning stages and encourage yourself to feel hungry. So to help frame the whole session, not just our first talk, I'll just offer 5 overarching questions that came to my mind as I was reading through everything. So one is it possible that we can really harness the emergence of blockchain technology to actually create more empowered relationships between people and money and between people and technology? Knowing this has been attempted before, knowing there have been failed attempts at this, so what are we going to do differently this time? What can we learn from the past? Secondly, how do we actually keep pace with the industry? How do we navigate that tension between kind of applied sciences and philosophy, like ethics into business models, and theoretical philosophy? Some of our speakers attempt to do that. I think some of them talk more in the theoretical and don't necessarily say, well, how do you get this into company practice? You know, how do we actually make sure it's happening? And there's a real speed issue. As I was saying, Wasim thinks we're at the very beginning, and we are in thinking through these questions. I would say that the industry is moving pretty fast. You already have huge governments thinking about building central bank digital currencies. I mean, there's a real pace issue. So there's a tension there. Third, if we do agree that the kind of default drive and governance model in our economies is around profit, not ethics, then how are we going to still build an ethical economic system, or a more ethical economic system? What might be the role of the user in that? What might be the role of engineers, new business norms, all kinds of things that might be able to be done because we're building the DNA of these economic systems. And then finally, because of this devotion to profit and speed, what are the ethical implications, not of the research that's being done, but of the stuff that's not at all being done, of the questions that aren't being asked, of the standards that aren't being formed? I mean, there's just a massive amount of work not being done. If we're having 2 hours here, I'm sure our researchers can speak to kind of how lonely the field is out there. And I, being in the user research domain, can tell you that almost none of the larger companies are doing user research, even though they're building products that affect millions of people. So finally, before I turn it over to our first presenter, I'll share a quote that for me kind of encapsulates the tension and the hunger and the discomfort that I feel. It's by the father of sociobiology, E.O. Wilson, and he writes, "The real problem in humanity is that we have Paleolithic emotions, medieval institutions, and godlike technology." And I think that those misalignments and tensions are really at play in everything that is being shared today. All right, so first we're going to have a paper by actually 5 authors, but we'll be hearing from just one of them, Akseli Virtanen. I'm supposed to say Akseli Virtanen. Got it. Okay, at least I got that the second time. It's called Rethinking Money and Credit in a Cryptoeconomy, Securing Liquidity Without the Need for Central Control of Issuance. Take it away.
Thank you. So, we have a mic here? No? Yes.
Is that good?
That's cool. Okay, it's better, sure, thanks. So, I'm Akseli, member of Economic Space Agency. We have also Pekko and Fabian from the Economic Space Agency team here. I'm a political economist, emphasis on both words, economist and political. I've written a lot about the history and future of economic technologies, and organized a handful of projects to re-engineer the protocol level of finance. And what I thought was that, you know, in order to act in the world, we need to first locate ourselves there. And we do this by telling a little story. So we have to tell a story about ourselves, about who we are, what we want, and what is going on in the world, and what are we going to do about it. So let me give you first the coordinates from which the paper is written from, just to make it a little bit easier for you to understand who we are, what Economic Space Agency is, and what we do. So what is going on? We know that economy is moving onto a programmable medium. But it also seems as one of the most hardest things to understand that what does it mean that economy and its key conventions are becoming design questions? And what we are doing, we are reprogramming the infrastructure, the protocols on which debt and equity, as the key social relations of capitalism, operate. Okay? Now, so what does this mean? One of my favorite finance theorists, Myron Scholes, they got a Nobel Prize for their options pricing work, together with Robert Merton and Fisher Black, said it very clearly in this is a quote from his Nobel Prize speech in 1997. He said that debt and equity, they are institutional arrangements, and time will continue to blur their distinction. So what he's saying is that equity and debt, they are historical. They are historical institutions, historical sets of relations. So he's saying that economy has a history, and that means that most likely it will also have a future. Sure, there's important technological development which is now making new things possible, but it's, from our perspective, it's essential that we understand cryptoeconomy in relation to the history of economy and finance and their conventions too. There's been a breakdown, and what he's pointed at here, there's been a breakdown in number of economic knowledges, like for instance the blurring of debt and equity, breakdown in a number of economic knowledges and conventions and practices which in combination actually create the actual conditions for the emergence of cryptoeconomy. So this is the point we are trying to make in the paper, that equity and debt, they're social relations, they're shared understandings and communication agreements according to which the capitalist economy as a network operates. Under different protocols, there can be different arrangements, and they can play different roles. And what we propose, the protocols in the paper, like credit for mutual liquidity and stake equity for mutual stakeholding, we think that they represent a profound change in our understanding of the future economic roles of debt and equity. Now, I'll try to get there. Yeah, so this was that slide. Then, in his speech, just in January this year, in the American Economic Association, Ben Bernanke came out with this idea for new tools, the new tools of monetary policy. I added the rainbow colors to the image because his new tools of monetary policy actually mean that he must readjust the definition of what normal means in monetary policy. Now, okay, so what do I mean? First, I mean, the official interest rates have been cut so frequently that they've gone negative. That was the earlier slide here. There is right now like 14 trillion USD bonds trading at negative yields around the world. I mean, borrowers are being paid to borrow. Savers are paying for the privilege of housing those savings in a bank. At the same time, the governments are just keep forcing the need for the austerity for the population, but continue to stand ready to pump liquidity into financial markets. If anything, the 2007 and 8 crisis, it didn't show the weakness of financial capital, but it showed that how its needs will dictate the policy agendas the state will enforce. Central banks, who after the crisis started quantitative easing, they started buying assets from the financial markets in massive amounts. And they promised to put the assets back to the market when the things normalized. Right now, they can't do it. It means that when the next economic crisis hits, and it will hit, all the central banks need to face the crisis with massively inflated balance sheets. And they have no new strategy, no new ideas of how to deal with the crisis except buying more assets. These are the Bernanke's new tools. Let's buy more. So they're basically so guaranteed in providing for the liquidity, guaranteeing the liquidity for the financial markets that they can't do little else. So it actually makes them like hostage to financial institutions, which actually are generating illiquidity. We are distorting market processes, or then with mispresentation of risk, as in 2007. Finally, the world's base interest rates, these are the overnight interest rates, which were thought to be risk-free. They are not working. Like just in 2019, middle of the year, there was a huge illiquidity which required massive injection from the Fed. LIBOR, which was once thought to be the most important number in the world, is going to be replaced by derivative indexes by the end of next year. Now, these like historic shifts in the foundation of money, they are challenging some of the key conventions of money right now. First of all, central banks are not controlling the money system. Their agenda is stability, but they can't provide it. They are looking really, really fragile. Secondly, the second big change is that big finance, is no longer focused on lending. It's not focused on borrowing and lending, on debt. Big action is around volatility. And debt is just a trigger for volatility. And these two things are not at odds. That is the system. Central banks are struggling to secure financial stability, and financial institutions profiting from that volatility. That is the system, and it is not stable. So we are thinking, from our perspective, and this is the perspective from which the paper is written, that we need new framings of stability. We need to rethink the role of stable coins in this slide too. I mean, being stable with respect to a fiat currency or basket of them, it's just one take on stability. But it embeds the primacy of the fiat over crypto and leaves the stability of the fiat currencies totally unquestioned. We think that the real potential in crypto economy is actually real social potential of crypto economy is here, to rethink the social role of money. Money as a series of social relations, money as a set of protocols. And when the next crisis hit, we want to be already there, like thinking, what kind of new stabilities we should have, what kind of new social relations, processes, goals that we believe should be constant. New metrics of stability. That's what we want. Where we want. We want to be there when the new, already thinking this when the new crisis hits. So these are the questions on which the paper works, on which we are working on the paper. Money and credit as a set of protocols of social relations. That gives us a different sort of stability. Cool. Okay. Now, this needs, we need to rethink money a little bit in order to get there. So, first of all, money is not one thing. It's heterogeneous. It is not some one thing that has some kind of self-identity. Most often, money is thought as some kind of a form of tautology. Money equals money, and it is through this self-identity that it's then able to render other things comparable. But money is not just what it is. It is not true that something either is money or is not money. It is not true that money just commensurates things by naming them with non-contradictory prices. Money is not just one thing. It's a system of relations. The monetary system is composed of an assemblage of different things. So when Perry Merling, one of my key favorite economic thinkers at the moment, thinkers of money and banking, when he says that, especially the protocols of money and the protocols of international banking, when he says, he's written a beautiful analytical analysis of how the money and banking actually work, when he says that all banking is just swap of IOUs, this is what he means. Money is not all the same. All money is somebody's promise to pay. All money is somebody's promise to pay. And all money are different instruments. Their value depends who you are and what you can do in the network. It's social relation. What is behind of the IOU? It's a social relation, it's a social contestation. So the illusion that all monies are equally money, it's maintained during the normal operations of monetary systems, and it means that the nature of the monetary system as an outcome of social struggle, who you are, what can you do in the network, is erased. So money is like put out of the questions in the sense that the configuration of the monetary system is taken off the table as an object of political negotiation and contestation. But as we've seen during the monetary crisis, money actually is called into question. The differences between different monies, they start to leap on the table. The difference between good money and bad money, the difference between the money of the rich and the money of the poor, it enters to the table, and money itself, the constitution of the monetary system, enters again the political imagination as an object of intervention and as a vehicle for the pursuit of justice. This is what we want to do. We want to call money into question. We want to re-engineer its protocols. Now, okay, so the modern regime of money, which emerged sometime between the founding of Bank of England in the end of 17th century and the French Revolution in the end of 18th century, it made this really clear because it was characterized by the monetary authority acting in concert with the most powerful private monetary actors which by producing par in the sense of creating the conditions of possibility for the different sorts of money to be exchanged to one another at zero or a marginal cost. Now, a note which trades at par means that its price is identical to its face value, which therefore means that it serves all the three functions of money equally and indifferently. It's a means of exchange, identical to itself, store value, identical to itself, and a unit of account. But it was not, it was only like in the 17th century where there were these different functions were separate, there were different things. There was a unit of account, pound sterling, there was a medium of exchange, a penny, and there was a store of value, silver and gold plate, which you had in your cabinet. They had different names and different physical instantiations. Now, so money, it's heterogeneous, and this is what we are trying to show in the paper. Okay, so, okay, I'll get to the last point. So, this is what we try to do in the paper. We try to separate, we try to put money into question. We try to bring money and credit into question in a distributed system. What do they mean? So we are separating the different functions of money. We are approaching them as different protocols with different tokens as part of them. And what does this mean? It means putting money into a question. It means giving everyone access and functional equality. So we know that liquidity, it's necessary ingredient of any economic system, of economic activity. Instead of atomic trade, this for that, there are things that don't yet exist, that have a temporality to be produced. And you need to open an interval for that. That is also why Keynes considers credit so important, so essential. So important. Money comes, this is what he repeats, money comes into being as credit. And credit is about opening this interval where things come into being. So it's really the intertemporal spread of social relations that is the key. Credit is not first about borrowing, leading to questions of debt levels and interest rates and default rates, but credit is about the form of mutuality over time, about the form of social relation over time, and of course about the volatility, social volatility that is native to that relationship. So what we're trying to ask in the paper is that what happens with distributed issuance? What happens if everyone can issue credit? And the simple conclusion is you can't charge interest on it anymore. If all agents can issue and clear, you cannot use debt as capital as a social relation. You can't use debt as a wealth accumulation device. If everyone can issue, issuance becomes a simple commodity, not something we need to pay premium for to a third party, to a lender, a dealer, or bank. And this is how the debt dealing system, the existing debt dealing system is based that there are those who can issue and those who can't. But if everyone can be both simultaneously through a protocol of reciprocal issuance of credit, it also means that everyone needs to become a clearer. Everyone needs to participate in distributed clearinghouse protocol. You can't have the one without the other, but you do not need to pay premium. Because there's no premium, the incentive is to clear credit as soon as possible and use it only as the interval opener, as this bridging mechanism for liquidity. So the issuance of credit takes only that role. So if we agree that everyone needs something like that, then the incentive for everyone is to issue and accept it. But if you can clear it immediately, does that imply that it's risk-free? No. No, it doesn't. It just means that there's another mechanism to offset that risk, and that's the co-issuance part of credit. risk is distributed among many peers. But it's important to understand that there is risk exposure in moving towards this peer-to-peer issuance and clearance. So if that is the downside risk, then what is the upside risk? Okay, if there's no premium paid on credit, would there be another way to capture it? Capture the upside risk in a different way? Well, if I provide you liquidity, which you need, which is necessary ingredient of economic activity, and then I provide it to you by issuing it to you, I should be entitled to some sort of some of your productive output, and the other way around. And that is what the stakeholding protocol does in our design. So we are proposing reciprocal credit lines based on reciprocal stakeholding, where we both stake on each other, or better, we stake on our relationship as a synthetic third party, and more value on that relationship, the more the credit line. And the consequence is that we start to engage in economic activity that is actually longing each other's positions. It shifts the logic. It shifts the logic from a more predatory one, where you owe me no matter what, where we are in a premium-seeking relationship, from predatory to risking together. It's a different set of relationship. It shifts the risk differently. It starts to change your behavior. Thanks.
Can you guys hear me? Great. If people don't have questions, I will be shocked. Who would like to start us off? Otherwise, I will start one. Oh, go for it. Great.
I'll hear you from... Okay.
I just, your notion of a sort of future liquidity system of lending that isn't based on interest but on stakeholding, basically, is already the sort of current model for the equivalent of banking in the Islamic world.
Sure. Yeah,
I mean,
absolutely.
so it's, you know, obviously from European systems, we get a different approach, but
yeah,
Sharia banking is already essentially what you're saying.
Yeah. Thanks for the question. That's absolutely right. But the thing is that not everybody can participate. The network is, the network as it works, there are some privileged agents who have different rights than others. For instance, I mean, the history of the New York Clearinghouse Association, it's a boys club who can actually participate there. And there are a hierarchy of different kinds of members. But it's a great protocol, the Clearinghouse protocol, if we can make it accessible for everyone. Yeah.
I guess a follow-up on that is that you guys write at the very end of the paper that these mutual systems rely on universal participation and mass adoption. And I'm super curious what you think are the current most important to focus on barriers to that adoption, and if any of the way you're re-articulating what money is, or you're kind of clarifying what money is, might help overcome those barriers, or make it more interesting or compelling or psychologically desirable to participate. How are you guys thinking of sparking adoption, essentially?
Yeah, that's the key question from our perspective. So we've been studying a lot, one of the legendary legends in the mythology of Silicon Valley too, Xerox PARC, and I think that there's a lot to learn how they approach it. I think that they were really smart in the way that they understood that they are actually confronted with a new paradigm. It's this new paradigm of computation, and they didn't quite know what it is, what you could do with it. But they made that as one of their most important tasks. Let's focus, like, what is this new computation? What can it do? How can we interface with it? What is it? And that's the way we are approaching it too. We need to be able to create, or we're thinking about it, that we need to create more literacy about it. And you know, they thought about it.
Great. I think we have another question. Wonderful. Thank you.
Yeah, thank you so much for the talk. It was really interesting. I have a question with respect to the situation where everyone lends to everyone. As I understood you, then there would be no interest rates. I asked myself, however, there's still default, right, as it's stepped. Why would any rational agent lend money out if he could expect less to receive back? And also time value of money.
That's a good question, kind of. That's precisely where we try to end up. So credit for mutual liquidity, it's not credit to get a premium, but it's a credit for securing the mutual liquidity, which means opening up the social spread, the time interval that new things can start to happen. It's a different function, it's a different role, what we see in the future for credit.
Okay, thank you.
Any other? Yes, go ahead.
Yeah, so one of the major things with this mutual stakeholding approach is that if we exchange stake on each other, this creates a natural alignment of incentives, that now your upside becomes my incentive and my upside becomes your incentive. So it's a very different model than to basically structure everything to cover it through interest rates. That you actually want to deepen the relationship. Like in such a model, credit becomes a good thing because it develops trust, it develops mutual exposure, and it creates a shared incentive to align efforts. And that's the primary motivation, to develop wealth. And we didn't really go into the value systems here in this brief presentation, but that then becomes the substantial focus in what kind of heterogeneous value forms can you develop on top of that, on that basis of being able to establish these peer-to-peer lateral relationships. So it's quite different from a purely kind of single criteria profit notion of optimization.
I think one summary you can make of it is it doesn't start from the paradigm of profit. It's rather what you're expanding is kind of your economic presence, which is also makes your social presence, because economy is social, wider. And so you kind of have to stop thinking in profit to see the benefits of the model.
I think we have time for one more question. Go ahead.
Yeah, just one more question. I'm curious because there seems to be like more emphasis on liquidity and sort of like more emphasis in like flows over stock. So how can you reconcile or connect, taxation and subsidies, and to what extent is it just purely because we need more liquidity, and through liquidity we can solve like social inequality, and how can you include or incorporate taxation and redistribution in order for this to work? Or
Thank you.
Oh, it's a big question, but I mean, what we think that these protocols, they are like information economy native. So there are different ways to discover the content, design different redistributions. Depends on what kind of risking together model you wanna build. It becomes a design question, really.
Wonderful. Thank you. Did you want to add one last point before we close up? Go for it.
Yeah, I think we really need to substantially move past what we consider money to be today, because a lot of this is based on the decomposition of the function of money. So the mutual stakeholding is basically the part that develops the relationship, whereas the liquidity provision deals only with the aspect that deals with the medium of exchange. And then decoupled from that, we use it as a measure for accounting, right? We have multiple functions that are kind of blurred together, and that actually they're interfering with each other. So that limits the use, how money can be used today, and isolating the just liquidity provision basically to provide the supply that it needs to be able to regulate based on the, like if you have more and more people that eat more food and live in more houses, you need to be able to expand the supply. But that is not something that you don't need to do credit money with interest to do that, because that becomes toxic if you go that route. Like, for example, here in the US, if you can issue legal tender, you could also issue a debt-free a treasury note. And it's that kind of thinking of regulating the supply as opposed to a credit interest-based money. That's basically the piece that we're trying to isolate there.
Wow. Well, as Erdos would say, my mind is open. Thank you all. If you guys want to say, are we clapping here? I haven't seen. Yeah, okay, I think that was phenomenal. Thank you.